Peter, we saw the market didn't like that. Absa closing down 8.3% lower than yesterday. Was this to be expected, or was it completely unexpected by the market?
I think it probably be a combination of both. I think, in my view, there were two issues really. One, that their mortgage book continues to perform poorly, and the second one, that revenue is not really, picking up. Looking at the mortgage side, I think it was a surprise to us. We thought, things were going to improve this time around. I think last year we saw Absa with about 35 billion or so NPLs, and about 23 billion of those were coming from the mortgage book. So we were expecting some, improvement this time. Revenue, I think to an extent, it was something that probably people should have seen coming. Not really for the sector, but particularly for Absa. I think why we have been kind of agnostic to Absa is the balance sheet structure. It is a loan to deposit ratio of over 100% when you exclude interbank type of deposits. So for us, that was always going to be kind of a constraint as to how it's going to grow its loan book going forward. I think the tricky part for us is whether it's a deliberate move, or it's because consumers are not really walking into their banking halls to get credit. That's very tricky to pick up, because I think in Europe the situation of consumers is probably going to continue to be pretext for most of the banks, to say the system out there is stressed, so we're not seeing people picking up loans. But to some extent, some of it could probably be deliberate, because a bank cannot continue to operate with a high loan to deposit ratios of 100.
Now, Absa said that new lending is actually picking up, but at a slow pace, and that we'll see that increase to the end of 2012. Do you think that'll be a major driver for them for earnings this year, or will they turn to more unsecured lending?
It could be, but I think the problem we have with Absa is, again, even when you look at the interest spread for Absa, it's the least of the big four banks. Net interest margins, it's high, I think around 4%, but interest spread is below 2%. And what that indicates is that the asset mix for Absa is significantly skewed to the higher yield side, which comes through when you look at the loan to deposit ratio. For them to continue to benefit from changes in the asset mix, I think it's going to be a bit difficult for them. So lending can still kind of pick up or grow, but there is a need for funding, And again, when you look at the debt distribution for Absa, I think Absa and Nedbank have the worst debt distribution. 75% of Nedbank's debt is maturing between now and 2015. For Absa, it's about 72%. So that put pressure on the funding, and that's going to be a bit of a constraint. Okay,
quickly, your thoughts on banking, your pick in this sector, because I see Absa is not the only bank that sold off today. We saw Standard Bank also trading down nearly 2%, coming into a level where it kind of looks attractive again if we compare it to its PEs of the previous 5 to 10 years and the dividend yield and that. So, and that has the exposure to Africa. Is that a pick for you in this sector?
It's quite a contrarian. I think I don't think it's a darling for most of the investors out there. Standard Bank, the African story we played, but we don't think it's a big thing. I think it's going to make contribution, but not significant contribution. Say, for example, in the next 3, 4, 5 years. So it's a good thing. So currently we have lots of holds. We are holding First Rand, which we were buying, and then we downgraded. We were holding Absa, which then went up, and we downgraded to sell. I think our target price for Absa is 145. Nedbank, it's a hold again. So we were buyers of the smaller banks, which again now I think they have rallied quite strongly.
Thanks, Peter. Okay. Thank you, Peter. Right. That was Peter Mushangwe, equity analyst at Legae Securities.